Delaware franchise tax is a fee businesses pay for the privilege of being incorporated in Delaware. It's not an income tax, but rather an annual payment required to maintain good standing with the state. Understanding this tax is crucial for any business incorporated in Delaware, regardless of where it actually operates. The Delaware franchise tax system is designed to be straightforward, which is one reason why so many businesses choose to incorporate there. This tax is completely separate from income taxes and has nothing to do with whether your business is actually a franchise. For corporations, the annual tax is due by March 1st each year, while LLCs and limited partnerships must file by June 1st. Along with your tax payment, you'll need to submit an annual report containing basic information about your business. The calculation method varies significantly depending on your business structure. LLCs and limited partnerships pay a simple flat fee of $300. For corporations, however, the calculation is more complex and depends on authorized shares. Delaware offers corporations two different methods to calculate their franchise tax. The first is the authorized share method, which is based on the number of shares your company is authorized to issue. The second is the assumed par value capital method, which factors in your company's gross assets and issued shares. The state allows you to pay whichever amount is lower, which can result in significant savings. For many corporations, especially startups with limited assets, the assumed par value method typically results in the minimum payment of $350 plus a $50 annual report fee. Filing your Delaware franchise tax is done online through the state's website. You'll need your business entity file number, federal employer identification number, physical address, and information about your directors and officers. The system accepts payment by electronic check or credit card. If you miss your filing deadline, you'll face penalties. For corporations, there's a $125 late fee plus 1.5% monthly interest. LLCs face a steeper $200 late fee plus the same interest rate. Delaware has earned its reputation as a corporate tax haven for several good reasons. The state charges no sales tax, no personal property tax, and no value-added tax. It also offers strong corporate privacy protections with minimal public disclosure requirements. Another advantage is Delaware's specialized Court of Chancery, which exclusively handles business disputes. This court's extensive case history and expertise in corporate law provide businesses with more predictable legal outcomes. Even if your business had no activity in the previous year, you still must file and pay your franchise tax. All Delaware entities are required to maintain compliance regardless of their operational status. For corporations with complex structures or high asset values, consulting with a tax professional familiar with Delaware's system can help identify the most advantageous filing method. The difference between the two calculation methods can sometimes amount to thousands of dollars in savings. Remember that Delaware franchise tax is paid in arrears, meaning the payment due is for the previous calendar year. This is an important distinction when planning your business finances and compliance calendar. Understanding Delaware's franchise tax system is essential for maintaining your company's good standing and taking full advantage of the benefits that come with Delaware incorporation. With its business-friendly tax structure and straightforward filing process, it's easy to see why Delaware remains the incorporation destination of choice for businesses of all sizes.